Ever made a decision that seemed smart at the time, but later made you slap your forehead and mutter, "What was I thinking?" Well, when it comes to your 401k, those missteps can cost you not just regret, but tens of thousands of dollars. Today, I'm going to reveal 5 costly 401k mistakes that people make all the time, sometimes unknowingly, and how you can avoid falling into the same traps. One of these mistakes cost someone I personally know over $50,000 in unnecessary taxes. And the worst part? It all seemed like the right move, until it wasn't. So, if you're banking on your 401k to fund your golden years, buckle up. This information might just save your retirement. Let's start with the elephant in the room. Most people don't realize that saving money for retirement and spending it in retirement are two completely different games. They assume the process of putting money into a 401k should look like the process of taking it out. Spoiler alert, it doesn't. And here's why. The government gives you a tax break when you contribute to a traditional 401k, but they tax you on the back end when you withdraw that money in retirement. Knowing that one fact can be the difference between a comfortable retirement and an accidental tax trap. According to a Vanguard study, savvy management of your 401k could increase your retirement income by up to 4% annually. With that in mind, let's dive into the 5 most expensive mistakes people make and how to steer clear of them. Mistake number 1. Leaving your 401k with a former employer. Over 55% of retirees do this, and not because it's wise, but because it's easy. You left the company on good terms, the account's already set up, and hey, it worked before, right? But leaving your funds behind means less flexibility, fewer investment options, and often higher fees. Plus, your old employer could merge, change plan managers, or make decisions that impact your account without you even knowing. Rolling your old 401k into an IRA usually provides more control, more visibility, and often lower fees. It also lets you consolidate accounts under one roof, making it easier to build a unified tax strategy and manage required minimum distributions, RMDs, later. The only possible exception. If you retire before age 59, 1-2, leaving funds in the 401k might give you penalty-free access under specific conditions. Mistake number 2. Withdrawing funds without a strategy. Pulling money out of your 401k without a solid plan can catapult you into a higher tax bracket, triggering thousands in extra taxes you could have easily avoided. Many retirees don't realize how withdrawal timing impacts their taxes. Sometimes waiting just a few months to cross into a new tax year can mean the difference between keeping and losing 10% to Uncle Sam. Others withdraw too little and miss opportunities to draw money at a lower rate. The smartest strategy, often, involves taking distributions between retirement and the year you hit your RMD age, especially while your income is lower. Coordinating this with your Social Security claiming plan and Medicare thresholds is crucial. A good financial advisor can help you balance all 3, ensuring you don't pay a penny more than necessary. Mistake number 3. Ignoring required minimum distributions. Once you hit a certain age, currently 73 for most, the IRS mandates that you begin withdrawing a specific amount from your 401k or IRA each year. Miss this deadline, and they hit you with one of the harshest penalties in the entire tax code, up to 25% of the amount you should have withdrawn. Your RMD is calculated based on your account balance and your life expectancy, and that percentage increases as you get older. Different account types also have different rules. What applies to a 401k might not apply to an inherited IRA. The solution? Automate your RMDs and set a calendar reminder every October to review your distributions. It takes 15 minutes a year and can save you thousands in penalties and the headache of dealing with the IRS. Mistake number 4. Going overboard with Roth IRA conversions. Converting traditional 401k funds into a Roth IRA can be a brilliant tax strategy, but overdoing it can backfire big time. Too many retirees push massive amounts into Roth accounts all at once, triggering a cascade of unintended consequences: higher income taxes, surcharges on Medicare premiums, and more Social Security income being taxed. These conversions are supposed to reduce your future tax burden, not increase it today. A better approach? Fill up your lowest tax brackets gradually, year by year. This bracket-filling strategy helps reduce RMDs over time, builds up tax-free income, and keeps your tax exposure minimal. Think of it as a slow-cook strategy for retirement taxes. Low heat, better flavor, no burn. Mistake. Number 5. Forgetting to update your beneficiaries. This one stings, and it's surprisingly common. People assume their will controls where their 401k goes after they pass. It doesn't. Your 401k and IRA beneficiary forms override your will. So, if you listed your ex-spouse or someone who's no longer part of your life as a beneficiary and forgot to update it, guess what? They're getting the money. Major life events, marriages, divorces, births, deaths, require a beneficiary form checkup. Failing to do so could create family drama, costly legal battles, or lost inheritances. The fix? Review your retirement. Account beneficiaries once a year or any time something major changes in your personal life. So, what's the move? Here's your action plan. First, consider rolling over old 401ks into an IRA for lower fees and better control. But double-check for any unique features your current plan offers. Second, develop a withdrawal strategy well before retirement that aligns with tax brackets, Social Security, and Medicare timelines. Third, mark your calendar for RMDs and automate those withdrawals. Fourth, take a thoughtful, strategic approach to Roth conversions. Slow and steady wins the tax game. And fifth, audit your beneficiary forms annually to ensure your legacy reflects your wishes, not yesterday's paperwork. Remember, your 401k isn't just a savings vehicle. It's a powerful tool that needs attention, planning, and care. It's not a set it and forget it account. It's the fuel for your future freedom. The steps you take today will echo for decades. Want to retire with confidence? Avoid these mistakes, and you'll be way ahead of the pack. If this helped you, then don't miss the next video. Please like and subscribe the channel. Thank you.